everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is the show where we get you an idea and a gist of what exactly is the latest news and headlines that could affect your money, your personal finances. We'll also, of course, help you out with your investing journey, be it in mutual funds or otherwise. And today on the show to talk about then investing in a market like this and how to manage your money, how to even manage a cash crunch if you may be facing. I am joined by Rahul Jain, Head of Edelweiss Personal Wealth Advisory. Rahul, thanks so much for joining us today on ET Now. Let's start off first by understanding, what we are facing. We are facing a market that's down. Every financial market has been affected. Every asset class has been affected, save gold. Mutual fund NAVs as well have tanked. And for many of our viewers, for many of our retail investors, mutual fund is that one simple tool through which they are able to save, as well as, of course, invest in the markets without having to put all of their minds into it, because a mutual fund manager essentially does that for them. But in the midst of what we are facing right now, what would you, I'm sure you as well must be getting a lot of phone calls, and emails and texts from your clients asking what their portfolio is doing and, what should they do with their investments. What's that advice that you are giving all these investors?
Yeah. So we are also getting similar nature. So I think the first step would be of client understanding is asset allocation. That is the first step. So for example, the composite mix between equity, debt, gold, and insurance, whether that is there or not there. If that is not there, then the first step is to align your portfolio according to asset allocation, which is on the basis of your age, risk profile, on your investment horizon. That is the step one. Once you are done with that, I think then the second step moves away of understanding the quality of portfolio and identifying that if there are any laggards on your portfolio, whether it's on the debt side or the mutual on the equity side, then figure those out and effectively then just get rid of them and get into a more stronger hands in terms of whether it's a stock, mutual fund, etc. So I think the realignment of portfolio on the basis of asset allocation, and then finally figuring out that what are laggards in the portfolio and then finally getting rid of them is something which is the need of the hour right now, effectively. Also, I think a piece of advice and what we have been also talking to clients right now, I think there is a lot of conversation which is going around cost consciousness across. I think in our portfolios also or the investment what we do or loans what we take, I think there are a lot of chances where we can improve our efficiencies or do some cost reduction. So for example, we have been going and advising our clients that if you have taken a loan, home loan 2 years back, and now if you can get a balance transfer done, I think there is a chance of you saving some money. So effectively what we have seen that right now you can at least save 75 to 100 basis point on your home loan rates because it has gone down in last 2 years. And effectively if you have a 50 lakh loan running and you save 100 bips, it's like 50,000 saving in a year's time. So which is a good amount of money. That is one. I think a lot of investors also use their credit cards as a line of credit, which is very, very expensive. I think they can move into personal loans, which is far cheaper. Again, it can be a big cost saving measure for them. So in these tough times, I think if you reallocate your portfolios according to asset allocation and move out the laggards and also find some cost efficiency factors in your portfolio, it can help you out in current times.
Okay, so let's start with step number one. That is realignment of assets allocation. And you mentioned age, which is a very important factor. So let's say somebody is maybe in their 20s or 30s. What would be a good division between different assets? And let's say if you're more on the later stage, maybe in your 50s or 60s or beyond, what would be a good asset allocation?
It's a very good question. So generally, if you see, advisors use a formula, which is 100 minus your age. So suppose you said about 25. The 100 minus age 25 is 75 should be an equity portfolio of yours. And on the basis of your risk profile, you can be wavering from 75 to 50 of equity portfolio. And then 40% can be debt and 10% can be gold. So that can be a good asset allocation for an age of 25. And suppose your age of 60, then your asset, then again 100 minus 60 is 40. But if your risk profile is low risk profile and your ability to take risk is low, then you should put only 25 to 30% in equity, then rest should be in debt and gold. That is how it's an easy way to understand and finally achieve your asset allocation. 100 minus your age should be an equity portfolio.
Okay, a very simple concept, and anything that's quantifiable is always really simple to put, be implemented. But I think the trickier part, I suppose, would be step 3 of what you mentioned, and that's essentially identifying the laggards and getting rid of them. But if someone is to open their portfolio right now, they'll notice that almost everything at this point of time is not performing well. I mean, many NAVs are below cost price for a lot of the mutual funds. So how then? I mean, are there any red flags as such within my entire portfolio which will tell me that, okay, look, you know what, this investment I definitely need to get rid of, or okay, this investment is losing for me, but it has potential and maybe I should just stay put?
So if you talk about mutual funds, I think there are 3 things which you can keep in perspective. First is that the investment policy, investment philosophy, what the fund has taken and whether he's sticking it to it or not in the various market cycles. That is one. Second is the past track record of consistency in various cycles, which is very, very important. And third one is the track record of the fund manager, whether he has been picking up the right stocks, right papers, etc. And if you're able to do that, I think then you're able to figure out then that whether you are on the right mutual funds or not. If you talk about stocks, I think companies with good balance sheet, companies with great corporate governance, companies who can emerge out stronger post-COVID are 3-4 criteria which an individual can understand or evaluate his stocks or mutual fund portfolio and then finally take a decision. I would also advise that if it's becoming complicated for you, then why don't you reach out to your advisor and he will help you out on these 3 parameters which I just spoken, and the life can be then easier for the investor.
So that's essentially about how to identify the duds, the ones that really perhaps have no hope of essentially seeing any sort of a recovery or a rebound, and how ensuring that you've eliminated them, because there's no point essentially of hanging around those. Okay, a very basic question, Rahul. Unfortunately, given the economic climate, a lot of individuals, be they salaried or businessmen, and I would say in fact more so for businessmen, salaried, if you're in a big corporate you're still okay, but either they are facing job cuts or they are facing a loss of income. Now they do have their SIPs going on, but how would you recommend they then manage money? I mean, if let's say they're really in need of cash and all, would redeeming SIPs be something that you would tell them to do right as a first resort, or you would try to ask them to postpone that for as long as possible?
So I agree. I think it's in uncertain times. I think if you ask me, the first step is for an individual to understand about his cash flows. That is most critical. That what are inflows and what are outflows, primarily outflows. And wherever there are unnecessary expenditure, I think that is something which he should cut. I think then he should build a corpus of around 6 to 12 months, and that corpus should actually go into effectively into liquid funds or FD, so that it can be used whenever he needs it. That is how I look at it. And the third step would be that from investment point of view, I think is now risk allocation will change. So his asset allocation needs to be changed. For example, if he was more on equities, and now since his job is uncertain or he's thinking of loss of income, my sense is his risk profile will become more moderated. Then I think he needs to go for an asset allocation change, which he can do in couple of months' time. Answering to your point, whether he should redeem his SIPs, whether he should stop his SIPs, I think from cash flow point of view, if it becomes necessary, he can reduce his SIPs. Redemption of SIPs or redeeming of SIPs would be a second matter. If he have some debt instruments on his portfolio investment side, then I think redemption of debt portfolio would be better, because equities are generally long term in your thinking, and then why should you go or redeem your long term investment for a short term challenge which you're facing? So I think debt reduction would be a better one if you have some debt instruments in your portfolio.
Okay, so redeem the debt portion of the portfolio first. If in case you're really in urgent need of money, that's a strategy that Rahul is recommending you could, go to. Let's take on board some viewer queries that we have received. First up, Darshan Vishnu writes into us saying, I'm 24 years old, a salaried professional, so he's pretty young. He said, I'm looking for sources where I can invest my safe enough that I don't lose any, and at the same time I get returns which in the long term can help me in accumulating a fortune or creating wealth. He has some moderate investments and endowment policy as well is going on, and he's willing to put in 6 to 8,000 rupees per month. So he just wants to essentially create wealth for the long term. He's got time on his side. He's a salaried professional. Rahul, how would you recommend Darshan start off?
So hi Darshan, I think congratulations to you first. I think starting your investment journey at such a young age, I think it's a very good one in that sense. I think since long term you're looking for long term investments, and for me long term is 10 to 15 years for sure, and you're planning to accumulate wealth or build fortune for you. I think the best way is go through a equity route and doing a SIP in large cap mutual fund for 6 to 8k over next 10 to 15 years, I think can build a good fortune for you. I think that the best part is that you're fortunate that age is by your side. To just give you some more perspective, a mutual fund SIP, if you put 1,000 rupees for next 30 years, and if it yields you at least 12% of return, which most of the mutual funds have given in last 10 years, then effectively your 1,000 rupees invested every month will become 30 lakh rupees, 33 lakh rupees effectively, and then the total amount invested is 3 lakh 60,000 in 30 years. So effectively you're doing a compounding of 10x. So power of compounding really help you out, and I think you should stick with your or you should do SIPs in long term manner and pick up large cap mutual funds, the high quality ones.
Quickly take on board one more question. Let's let's take on board the next question, which is coming in from Joydeep Datta. He says, I have recently retired, wanted to know what are the relatively safe MF investments in debt fund variant or a combination of two or more mutual funds, which would be better from a return point of view than a traditional annuity product which a lot of insurance companies give. He also wants to know, he said he'll be investing by redeeming lump sum from the PF corpus, would suggest a mutual fund with SWP, and the main objective would be to get a monthly income that will take care of expenses, and that's the reason why safety of that investment as well is important for him. So it's a little tricky. He's already retired and he's depending on these investments to get by on a monthly basis or on a daily basis, because he will be depending on his essential expenses on these investments. A tricky one. What would you recommend, Rahul? Is debt fund the right way to go by?
So hi Joydeep, thanks for your question. I think since Joydeep has retired and it will be his sacred money which is used for retirement, I think safety is very critical and important, and also he's looking for regular cash flows. So I would suggest that he should buy debt papers like a RBI bond, which is for 7 years at 7.75, high rated NBFC FD like an SDFC, and a AAA rated NCD. So effectively, if you see, if we invest in a combination like this in 3-4 papers, which are fairly safe and protective, and also give him regular cash flow, I think is his objective of safety, because that is paramount right now at his age, and also getting cash flow. I think then it can be a good combination, and you will end up making a 7.5 to 8% return on annual basis, which should be reasonable, keeping safety in mind.
So you mentioned high-rated corporate bonds, right, Rahul?
Yeah. Yes. So I rated so SDFC Limited FD, for example. RBI bonds, which are just their primary issuance is going on. I think AAA rated NCDs. So I think these all are very, very safe and also give you good return, keeping safety into perspective. And also it helps you getting regular cash flows, which is a very important need for Joydeep right now.
Yeah, all right. Okay, I hope our viewers have taken note of the recommendations that you have given. Rahul, thanks so much for joining us today on this episode of The Money Show. For all our viewers, if we've not been able to take your query today, don't fret, or just keep writing into us on The Money Show at etnow.tv, and we will get them answered over the course of the next couple of days. Meantime, just want to address some news that has come out from SEBI, and this could perhaps be a breather for especially the Franklin mutual fund investors. However, I'm unsure if it would be applicable to them as well. For now, we perhaps need some clarification from SEBI, but this is quite an important one. SEBI has said that mutual fund schemes which are winding up shall be listed on recognized stock exchanges. These units can eventually be listed and they can be traded as well on exchanges, just how you trade a regular stock, and this in turn would essentially help provide an exit for investors. Do remember that when Franklin said it has to wind up its funds, it basically meant that investor money is stuck. They cannot redeem it because cash at this point of time is something that Franklin does not have. And yeah, the AMC, by the way, will not be permitted to transact in the units of the scheme that obviously is still being wound up. That still stays. But yeah, that's the latest coming in from SEBI. Well, on that note, we will take a very short break, but when we return, Prashant Thakur of Anurok will be joining us to tell us what exactly the FM's announcements mean for the realty sector.